Hi, everyone. Welcome back to FIN4324 Commercial Bank Management. I'm Dr. Dennis, and this is our Week 3 live chat, Part 1. In this session, we'll take a deep dive into economic indicators and loan and deposit pricing, two areas that really drive how banks operate and compete. Let's dive in. When we say economic indicators, we're talking about the big picture data that helps us interpret the health of the economy. Banks, in particular, rely on these indicators to anticipate changes, prepare strategies, and manage risk. Think of these as the dashboard gauges that let us know whether the economy is speeding up, slowing down, or overheating. Here's the lineup of indicators banks watch most closely. The Fed funds rate, Treasury security rates, GDP growth, inflation, money supply, housing starts, stock indexes, property prices, unemployment, and more. Each of these tells a different part of the story, and together, they give banks a roadmap for decision making. The Fed funds rate is the interest rate banks charge each other for overnight loans. The Federal Reserve sets the target for this rate, and it has a domino effect on everything else, from prime lending rates to what you earn on savings accounts. If you want to stay ahead, track what the Fed is signaling in its quarterly meetings. Markets often move just on anticipation of what the Fed might do. Treasuries are the classic risk-free investment because they're backed by the U.S. government. There are short-term T-bills, medium-term notes, and long-term bonds. Banks and investors use the yield curve from these securities to read where the economy is likely headed. A normal upward curve signals growth, while an inverted curve often points to recession fears. Gross domestic product, or GDP, functions like the economy's report card. It measures the total output of goods and services and is released quarterly. When GDP is growing, businesses expand, hiring increases, and banks see higher demand for loans. When GDP contracts, banks tighten lending and prepare for leaner times. Inflation is all about rising prices and the shrinking purchase power of the dollar. The Fed targets a 2% inflation rate to keep things balanced. Too high, and purchasing power erodes. Too low, and growth stalls. For banks, inflation directly influences interest rates and the demand for credit. Money supply. M1 and M2, the categories of money supply, track how much money is circulating through the economy. More money in checking and savings accounts means more funds that banks have available to lend, which fuels growth. But too much growth can trigger inflation. The Fed manages this balance by buying or selling securities in the open market. Housing starts are a classic leading economic indicator. When new home construction is strong, it signals optimism, job growth, and consumer spending. Banks benefit by writing more mortgage loans, but housing is also highly sensitive to interest rates. When rates rise, housing demand cools off very, very quickly. The stock market, particularly the Standard & Poor's 500 or simply S&P 500, reflects investor confidence and corporate health. Rising markets can boost consumer wealth and bank investment portfolios as well, while falling markets can erode confidence and tighten lending standards. Property values, both residential and commercial, are another signal of economic strength. Rising property prices can fuel lending, especially in mortgages and commercial real estate. Declining prices, as we saw in 2008, can trigger widespread financial stress. The unemployment rate is one of the Fed's two main targets, alongside inflation. Low unemployment means more income, more spending, and more borrowing. High unemployment signals distress and usually prompts the Fed to lower rates to stimulate growth. When businesses and individuals can't pay their bills, bankruptcies rise. Banks, of course, see this as a red flag. Chapter 7 bankruptcy wipes the slate clean. Chapter 13 requires payments over time. And Chapter 11 is for corporate reorganizations. A rise in bankruptcies typically indicates a weakening economy. Interest rate swaps allow banks and companies to manage exposure to changes in interest rates. Typically tied to LIBOR, now transitioning to SOFR, SOFR, the swap rate helps banks manage interest rate sensitivity. Understanding swaps is crucial for risk management. Chapter 9, Introduction to Pricing. Pricing in the banking world comes down to one thing: interest rates. Whether it's what you pay on a loan or what you earn on a deposit, pricing determines profitability. Banks must walk a fine line, price competitively to attract customers, but also maintain adequate margins to stay profitable and stay in business. Loans are the biggest asset on a bank's balance sheet. Pricing them involves covering the cost of funds, adding a premium for risk, and of course including a profit margin. Because competition is fierce, banks must constantly adjust rates in order to keep customers without giving away the store. Business loan pricing is where things get interesting and tough. Unlike consumer loans, business loan rates are highly negotiable. The bank must charge enough to be profitable while compensating for risk, but not so high that the client walks away to the competition. Methods include cost-plus pricing, price leadership, and customer profitability analysis. Most business loans float against an index, typically the prime lending rate or LIBOR, London Interbank Overnight Rate, which is now shifting to SOFR for Secured Overnight Finance Rate. The formula combines the base index with a spread for risk and maturity. That spread is where banks make money while balancing risk. The cost-plus method builds a loan rate step by step. Cost of funds, operating costs, risk premiums, and desired profit. Add those together, and you've got your interest rate. This method is straightforward, but competition may push actual rates lower. In price leadership, banks peg rates to market indices and move with the competition. If the Fed changes the funds rate, the bank's entire loan portfolio may reprice. This method ties the bank's rates more directly to market conditions. Customer profitability analysis is a relationship-based approach. Instead of pricing a single loan, banks look at the customer's entire relationship, their deposits, other products and services, and then they price loans based on the total return. The goal is to maximize profitability across the relationship, not just on one product. Earnings credits give businesses a break on loan costs if they keep large balances on deposit. This is a win-win. The customer enjoys better pricing, and the bank gains access to more stable deposits. Consumer loan pricing is less negotiable than business loans. Installment loans, mortgages, and credit cards are priced competitively, but fairly standard. Factors include interest rate, balance, and loan term. The goal is to keep rates attractive enough to win borrowers while still remaining profitable. The cost-plus method applies here as well, covering the bank's funding costs, operating costs, risk, and profit margin. For consumer loans, this is usually expressed as an annual percentage. The annual percentage rate, or APR, is the rate consumers see. It represents the cost of borrowing, including interest and fees, expressed annually. It is designed to help borrowers compare costs across different lenders. For banks, transparency here is not optional. It is legally required. A fixed-rate mortgage is locked in at closing and stays constant throughout the loan term. The predictability makes it attractive for borrowers, but it shifts interest rate risk to the bank. If rates rise, the bank is stuck with a lower return. Adjustable rate mortgages, or ARMs, on the other hand, shift the interest rate risk to the borrower. Payments adjust as market rates change. When rates are low, ARMs are very appealing because monthly payments drop. But when rates rise, borrowers face higher payments, sometimes leading to financial stress. Mortgage points are upfront fees. Each point equals 1% of the loan amount. Lenders may require points depending on credit scores or down payments. Borrowers often face the decision: pay points up front to get a lower rate, or skip them and accept higher payments for the entire term of the loan. Deposit pricing is the flip side of the equation. Banks want to pay enough interest to attract deposits, but not so much that profits are wiped out. Competition sets the tone here. While deposit rates tend to lag changes in Fed policy, they always adjust eventually. And that wraps up part 1 of week 3. We've explored the economic indicators that shape the financial environment and the methods banks use to price their loans and deposits. Remember, these are not simply academic topics. They're practical tools you can use to have a better understanding of financial markets, banking strategies, and even your own borrowing decisions. Stay curious, keep exploring, and I'll see you in part 2.